The euro is losing ground even while the dollar is supposed to be collapsing. Right now, the dollar index is down for the week on the back of Iran peace hopes. Yet euro to US dollar just printed a fresh multi-day low. That is a hidden trap, and if you are positioned the wrong way, you are about to get liquidated. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, with precise entries, stops, and risk-reward ratios that the retail crowd will ignore. Write this number down, 1.1523. That is the line in the sand. If the market accepts below 1.1523 on a 4-hour closing basis, the entire structure resets, and we are looking at a fast move toward 1.1469 and potentially 1.1435. The session bias is aggressively fading rallies. Every trend signal across the weekly, daily, 5-hour, and 1-hour charts is screaming strong sell. The monthly chart still holds a buy structure, but that is a lagging signal right now. It is the equivalent of looking in the rearview mirror while the car is already skidding off the road. The herd is still trying to buy the dip because the dollar headline about Iran peace looks bearish for the greenback. But that narrative is a decoy. What matters is the euro's inability to rally on a supposedly weak dollar day. That tells you real money is distributing euros. The ADX might only be reading 23, indicating the trend is not yet thunderous, but the CCI is sloping down from deep negative territory, and the MACD histogram is printing lower lows below the zero line. This is a slow bleed that turns into a flush. The single invalidation level that flips my bearish bias intraday is a 1-hour close above 1.1611. If that happens, the trapdoor seal shut temporarily, and we could see a short covering spike toward 1.1645. But as of now, the path of least resistance is south, and I will show you exactly how to exploit it. Let me walk you through the chart from top to bottom. On the weekly time frame, the 200-week moving average is not in play currently, but the 100-week MA is sloping down around the 1.18 handle, and we are miles below that. The weekly candle has made a clear rejection of the 1.1699 resistance zone 3 weeks ago, and now we are stair-stepping lower. Weekly MACD has crossed bearish, and the histogram bars are expanding, which tells you momentum on the institutional level is aligned with the strong sell reading. Flip to the daily chart. Price is trapped below the MA200 at 1.1588 and the MA50 at 1.1644. Every day for the past week, we have seen intraday rallies sold off before the European close. The MA20 on the daily is 1.1598, acting as dynamic resistance. This is the first bearish check. Euro to US dollar cannot even manage a daily close above the 20-day moving average. That is a classic weak market. The daily RSI is 43 and falling, nowhere near oversold, meaning there is plenty of room for further downside before any mean reversion trade becomes high probability. The stochastic at 28 is pointing lower, not yet curling, so we are not at an exhaustion point. This is a trending move within a daily strong sell structure. Now here's what most traders miss. Drop to the 4-hour chart. There is a hidden bearish divergence forming on the MACD relative to price. Price made a lower high on Monday near 1.1645, but the MACD histogram printed a higher high on that swing, and since then price has rolled over with the histogram collapsing. That is a classic momentum exhaustion signal before the next leg down. On top of that, the 60-minute chart shows price failing to reclaim the MA200 at 1.1588 after yesterday's New York session. The 60-minute MA20 is curling below the MA60, and we are seeing bearish crossovers on every short-term moving average ribbon. The 60-minute ATR is 56 pips, so intraday ranges are about 55 to 65 pips. This is more than enough for a clean sniper entry if you understand where the stops are resting. The pivot point for today sits at 1.1557, and we are trading just above it at 1.1569, but the candle bodies are struggling. The Williams percent range is at -64, not in oversold territory, meaning the market can still push lower without a snapback. Support levels on the screen. S1 is 1.1523, S2 is 1.1469, S3 is 1.1435. Resistance levels are 11.1611, R2 1.1645, R3 1.1699. The 1.1523 level is not just a random pivot calculation. It lines up with a previous daily demand zone from 2 weeks ago and an order block on the 4-hour chart where institutional buyers stepped in briefly. If that level breaks, the stops underneath are massive, and the move will accelerate. Gold is moving tick for tick with the dollar right now, and the S&P 500 futures are holding up on the Iran peace narrative, creating a false risk-on bid that is keeping the euro afloat for a few more hours. But the bond market is screaming a different story. 2-year German bond yields are falling faster than US yields, meaning the rate differential is widening against the euro. That is the dollar killer dynamic at work. The cross-asset linkage is clear: equity stable, gold choppy, euro heavy. That combination usually precedes a dollar spike that catches the late-to-the-party euro longs off guard. The last 24 hours of news changes everything because it paints a bull trap dressed in peace headlines. The Iran peace hopes are driving the dollar lower against commodity currencies and the yen, but the euro is not participating in that move. That is a glaring red flag. The ECB speaker calendar has been light, but the market is slowly waking up to the idea that the ECB might have to cut earlier than the Fed if German manufacturing data continues to deteriorate. The sentiment shift is subtle, but you can see it in the analyst notes. The phrase euro to US dollar resumes wave C decline as US dollar strength returns is the core institutional view. Wave C targets on the weekly chart point toward the 1.12 region, but in the near term. The 1.14351.1469 zone is the next magnet. For the next 1 to 2 weeks, my directional lean is bearish as long as the daily close stays below 1.1699. The event that invalidates this outlook completely is a daily close above 1.1699 with expanding volume. Until then, every rally is a shorting opportunity. Do you think the euro breaks 1.15 this week? Comment yes or no below. I'm tracking consensus right now because the moment retail flips bearish en masse, we might get a tactical squeeze, and I want to see where you stand. Most people skip this section. That's exactly where the money is made. Keep watching because I'm about to hand you 3 fully structured trade plans with exact numbers you can screenshot. Strategy 1, the sniper, conservative approach. This trade is for those who wait for confirmation and want a high probability entry. The trigger condition is a 4-hour candle close below the 1.1523 support level. You need a decisive break, not a wick, a full body close beneath that pivot, ideally with the 4H RSI below 40 confirming momentum. Once that prints, the entry is a sell limit at the retest of 1.1523, now acting as resistance. Your stop loss goes at 1.1557, just above today's pivot point and above the short-term volume-weighted average price that trapped early sellers. That gives you a 34 pip stop, which is well within the daily ATR. Take profit 1 sits at 1.1469, the S2 support level, providing a 54 pip gain. That is a 1 to 1.6 risk reward right off the bat. Take profit 2 is at 1.1435, the S3 level, delivering a 88 pip move from entry, for a 1 to 2.6 ratio overall. This setup is voided entirely if price fails to close below 1.1523 on the 4-hour candle and instead bounces back above 1.1557 with a sharp rejection wick. Patience is key. Do not front-run the break to the sniper, conservative, entry. Sell limit January 1523, after 4 hours close below stop loss, 1.1557 take profit 1, 1.1469 take profit 2, 1.1435 risk, reward, 1:2.6 invalidation. Void if 4H candle wick remains above 1.1523 and price reclaims 1.1557. Strategy 2. The active trader, standard approach. This one targets the mean reversion fade within the prevailing bear trend. The entry condition is a pullback to the 1.1611 resistance. That's the R1 pivot, combined with a 1-hour bearish engulfing candle close or a 1-hour MACD histogram tick down from overbought territory. The stop loss is placed at 1.1645, above the R2 and the MA50 on the daily, a level that if broken would indicate the bearish structure is under threat. That's a 34 pip stop again. Take profit 1 is 1.1560, just above the MA5, for a 51 pip gain. Once take profit 1 is hit, move the stop to entry and let the runner target take profit 2 at 1.1523, the critical support, giving you an 88 pip total move from entry. This provides a risk reward of up to 1 to 2.6 if both targets fill, with a break-even guarantee after the first. The reason this works is because the daily trend traders and the 4-hour momentum traders both see 1.1611 as an area of supply. You are joining the prevailing flow with a defined risk box. Only enter if the 1-hour RSI gets above 55 and then rolls over. That is your confirmation that the bounce has run out of steam to the active trader, standard, entry. Sell at 1.1611 on 1H bearish engulfing and RSI rollover from above 55 stop loss. 1.1645 take profit 1. 1.1560, then move stop to break even, take profit 2. 1.1523 risk, reward. 1:2.6 invalidation. Void if 1H candle closes above 1.1645. Type your euro to US dollar range for tomorrow in the comments right now. Give me your high and low. Let's see who's aligned with the institutional flow. I read these numbers, and I'll reference the consensus in tomorrow's video. Strategy 3, the aggressor, high risk, high reward. This is for traders who can stomach a 20 pip stop and want to capture the momentum on a breakdown that might not wait for a retest. The entry is a market sell if price trades below 1.1557, today's pivot, with a 1-minute candle close that shows aggressive selling. Think a red candle with a wide range and no lower wick. The stop loss is tight at 1.1588, just above the 200-hour moving average, which is the immediate intraday resistance. That's a 31 pip stop. Take profit 1 is set aggressively at 1.1523 for a 34 pip gain, roughly a 1 to 1.1 ratio. But if momentum is strong, you hold for take profit 2 at 1.1469, delivering a potential 88 pip gain, making it a 1 to 2.8 risk reward. This is a momentum chase entry on a smaller timeframe extreme. The warning is explicit. Only risk what you can lose in under 30 minutes, because whipsaws above the pivot can happen in the blink of an eye. Do not try this without a hard stop already in the system. The aggressor play exploits the fact that if the herd stops below 1.1557 get triggered, a cascade can begin, and you want to be positioned before the acceleration to the aggressor, high risk, entry. Market sell below 1.1557 on 1-minute close with wide bearish candle stop loss. 1.1588 take profit 1. 1.1523 take profit 2. 1.1469 risk, reward. 1 to 2.8 invalidation. Void if price recaptures 1.1588 within 5 minutes of entry risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact central bank speakers or surprise headlines. Stops are non-negotiable. This is how you survive to trade the next big move. The market will always offer another setup. Your job is to be there when it arrives. Tomorrow's wildcard. We have a scheduled ECB speaker at the European Open, and any hint of a dovish tilt will be the match that lights the 1.1523 breakdown. On the other side, if the speaker pushes back against rate cut expectations, we could see a short squeeze toward 1.1645. The single most critical level for the next session is still 1.1523. If it goes, do not hesitate. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. I cover all 8 assets every day with the same institutional depth. Smash like if this gave you a clear plan for euro to US dollar. Subscribe, hit the bell, and I'll see you in the next one, before the move happens.